Okay, so in this video, we're going to get right to it and we're going to be talking about income. Okay, how to calculate it, how to be as accurate as possible. And we're going to talk about it because really, and we're looking here at the maximum budget. Um, it's the most important part of the entire mortgage approval process is income. Now, a lot of people might say, "Hey, what do you mean income is the most important part? What about credit? And or what about debt to income? Or, whatever else they might say." Um, Credit is also very important, but if your credit isn't where it needs to be, more than likely, I can get you right and ready in 3 or 4 weeks. And with debt to income, it is also very important, but debt to income is something else that can also be manipulated, by paying off credit cards, by paying off credit cards, or just, by consolidating credit cards. It can be manipulated. And again, more than likely, I can get you right and ready in a month or so if you have debt to income issues. But income, we can't go back in time, get you a new job where you're making more money, or most people can't just decide to start a new job where they make more money. And it's definitely, at least as of right now, impossible to go back in time and start a job 2 years ago, because you do need, for at least for traditional loans, and we're going to talk a little bit about non-traditional loans, but for traditional loans, you have to have 2 years of on the job time, or at least 2 years in the same line of work. Okay. So different lenders calculate it slightly differently, in terms of, some lenders use the average of the last 2 years. Some lenders use what your income is based off of your year to date. So if you're tracking to be on a slightly higher income, then some lenders have the ability to decide to use that. So it varies slightly, but you can just put in this first, for the purposes of the calculator, you can just put the combined income. So if it's you and a significant other, just add up your yearly income and you can put it here. Okay, so if you make 50 and your partner makes 50, that's 100, and just get it so it's right around 100,000. It doesn't have to be exact down to the penny. Again, this is a tool for educational purposes, just to give you a rough idea. Okay. So you just add up both of the incomes. Now, again, calculating the income, it's easy if you're a W-2 employee. If you're a W-2 employee, you just put whatever the W-2 says that you made for you and for your significant other. Now, if you're self-employed, now we're going to talk about a few different programs, because if you're self-employed, what they're looking at is the income that you paid taxes on. So there's a lot of self-employed individuals. There's a lot of 1099 or individuals that are contractors that get paid via 1099. A lot of nurses get paid via 1099. So what that 1099 says, that's your gross income. And from that, you deduct expenses. So what they're going to count is the income after you deducted those expenses. So if you have a 1099 that says $100,000, but you deducted $50,000 or $60,000, then it's after the income that is actually going to count towards a traditional loan is $50,000 or $60,000. Now, a non-traditional loan, and the reason why you wouldn't just automatically go to a non-traditional loan, it's a little bit easier to qualify for, but it has a slightly higher interest rate, and you need more money down. You can't do 3% down. You can't do 5% down. It starts at 10% down for these non-traditional program. And that's with good credit. It goes up from there depending on your credit and a few other factors. Okay. So for the non-traditional loans, we can use just your 1099 income. So if your 1099 income says $100,000, then we can use $100,000 for income. There's also a bank statement loan. A bank statement loan, they just look at your average deposits on a monthly basis, and they use a percentage of that. Sometimes there's an expense factor, sometimes there's not. It depends from lender to lender. It's my job to go out and find the most advantageous approval for you, and that's why we work with a big network of lenders, because everybody has their own areas of preference. Each lender has their preferred sort of deals. So yes, so that's something to keep in mind about income. There's bank statement loans in which, sometimes the expense factor is 50%, 40%, 60%. It just depends on the line, on the industry. Sometimes it's 10%. Sometimes they don't take out any expense factor. Just depends again on the rules of the individual lender. If you're doing a traditional loan includes FHA, VA, USDA, or just like a regular conventional loan. Then it's you have to be on the job for 2 years, or at least in the same line of work. It's okay if you have a new job. If you were a mechanic at one dealership and you move to another dealership, that's the same line of work. If you were a mechanic before and you're a mechanic now, that's the same line of work. Okay, the same line of work. 2 years, they're going to take the average of 2 years. Now, another quick thing about overtime. With overtime, they count a portion of it. They will count all of it if the overtime has been consistent for the last 2 years. If the overtime has not been consistent, but you've been collecting over the last 2 years, then they take like an average. If you've only been doing overtime for the last few months, then some of that income is not going to count. That's in just the overtime income. Okay, just to let you know. So that is a little bit about gross income and how to get that as accurate as possible. Thank you very much, and we'll be on to the next one.